Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at TCOM, or Trip.com Limited. TCOM is a multinational travel company based in Shanghai, China. Here's the barchart.com technical opinion rating for TCOM. The bar chart rating is a 100% buy with a strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that TCOM is well above the moving average line, so the monthly trend in TCOM is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since September, so the daily trend in TCOM is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. TCOM is slightly below the upper Keltner channel line, so TCOM is inside the buy zone. Since the trend is up, we want to buy a call. TCOM has 8 option chains to choose from. We're going to use the Feb 21 option chain. Right now, the Feb 21 options have 76 days to expiration. Our call option calculator, let's see. Here's the TCOM option chain, for Feb 21. TCOM closed at 69.07 on Friday. That means any calls on the list from 35 to 65 are in the money. Let's take a look at the profit potential for purchasing the 70 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 70 call is 420 to 6. We try to enter at the midpoint, so we'll use 510 as the buy price. Our call option calculator shows the profit potential for this call based on TCOM price changes at option expiration from flat to a 12.5% increase in price. We can see that if the TCOM stock price is flat at 69.07 at option expiration, the 70 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 60 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 60 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the TCOM stock price is up 1%, the 60 call will lose 12.1% of its value. We want that to be break even or better, so the 60 call does not meet our requirements. Let's see if the 50 call will work. The bid-ask spread for the 50 call is 17.90 to 21.60. We tried to enter at the midpoint, so we'll use 19.75 as the buy price. The 50 call works. If the TCOM stock price is up 1%, the 50 call will make a 0.1% or $1 profit. That's better than break even, so the 50 call is the one we'll buy. The call option purchase calculator also shows that if the TCOM stock price increases by 2.5%, the 50 call will make a 5.3% or $105 profit. If the TCOM stock price increases by 5%, the 50 call will make a 14% or $277 profit. If the TCOM stock price increases by 7.5%, the 50 call will make a 22.8% or $450 profit. The plus 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the TCOM stock price does not make the expected move up and remains flat at expiration, the 50 call will only lose minus 3.4% or minus $68 compared to the minus 100% or minus $510 loss for the 70 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the TCOM Feb 21 55 strike call and sell to open the Feb 21 65 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 55 call for $15.10 and sell the 65 call for $7.65. $15.10 minus $7.65 equals $7.45. So the entry price or debit cost for the spread is $745. The call option spread analysis calculator picture shows that the spread will make a 34.2% or $255 profit if the TCOM stock price declines by 5%, remains flat, or increases in price when the options expire. If TCOM is down 7.5% at expiration, the trade will make 19.3% or $144. Creating the debit spread will allow us to collect a $765 cash credit to our brokerage account for the sale of the 65 call. As we said on the previous slide, this reduces the cost of entering the spread to $745. Here's a note regarding earnings reports. The next TCOM earnings report is scheduled for Feb 17, a few days before our trade options expire. Let's review the trades one more time. The first trade was a call purchase, said to buy to open the TCOM Feb 21 50 strike call for $19.75. We also reviewed the spread. The spread said to buy to open the TCOM Feb 21 55 strike call and sell to open the Feb 21 65 strike call at a debit of $745. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.